So how do accounting firms actually make money? As you know, I'm a chartered accounting firm. We've been operating about 5 years now. And sometimes I get asked, is it profitable? Accounting firms, like a lot of professional services firms, are actually a great industry to be in. One of the best reasons is they're boring as hell. Nobody wants to do it. And I mean that quite sincerely, right? It's actually an industry where I'm actually relatively young for this industry. Most people in the industry are over the age of 60. It is an industry where there's a shrinking number of people in the profession at the moment, especially those registered as tax agents. So as an opportunity, it's fantastic because you've got a shrinking number of providers and an increasingly complex business environment in which to operate. Yeah, but how do we actually turn that into cash? Because ultimately that's what we're here for, right? We're a business. So the way we make money is we start obviously by doing work for our clients. Our biggest cost is actually our people, labour costs. And most labour costs for an accounting firm run at about 35 to 40% of the revenue. Okay, so if you have $1 million in revenue, generally speaking, your labour costs are about $350,000 to $400,000 of that $1 million. Okay, that's step one. Step two, overheads. Overheads generally between 25 and 35%. Okay, and what do overheads consist of? Well, in an accounting firm, it's rent is usually the next one down, software costs, regulatory costs, because we're a heavily regulated business, insurance, training and development, because we have to spend a lot of time training. In fact, I have to do 60 hours a year as a tax agent, and most of my staff have to do 30 hours a year each of training. So what's next? Well, how do we charge for our work? Now, accounting firms traditionally, like a lot of law firms and consulting firms and engineering firms, charge by the hour. Right? Now, this model is sort of changing a bit, but ultimately, all we have at the end of the day is 8 hours a day, 5 days a week. And that's all we got in terms of time, without obviously excessive overtime and killing ourselves working stupidly long hours. And so that's why, as your limiting factor in your business, time is what you've got. That's what we're selling. Now, some firms will tell you that they're value pricing, and some firms will tell you they're doing fixed price contracting, etc., etc. But ultimately, the amount of work you can do is constrained by the amount of time, how well you're efficient at it, and how well the level of expertise is in that work. Okay, so we have a chargeable hour. Right? My charge out's $400 an hour. My staff charge outs are anything between $135 an hour and $250 an hour. So how do you work that number out? Well, the maths is relatively simple. We work out how many chargeable hours we have a year. Might be 1,500, 1,400, 1,200 chargeable hours per year per person. That takes into consideration obviously leave, holidays, downtime, the fact that we can't charge 7 or 8 hours a day. We're more likely to charge 5 or 6 hours a day. Then we work out, okay, well, how much salary and wage do I have, the person? So they're a senior, tax senior, they're making $100,000 a year. 100,000 divided by chargeable hours gives you how much direct cost per hour they have. Then you've got the overheads. Okay, and you again got to spread those overheads over all the chargeable hours, and that'll give you an additional number. Let's say it's an extra $50 or $60 per hour, and then you want a margin on top of that because you're to make profit, right? That's the purpose of being in business, is to generate a profit margin. Most accounting firms generate between 30 and 40% margin. So a good accounting firm would generate 40 plus % margin. An average firm generates around 35% margin. A not so profitable firm generates below 30. But let's stick with 35% as kind of the average for SME accounting firms in Australia. And indeed even mid-tiers and dare I say the big four as well, are probably around the same sort of number. So you add a margin on top of that, and that comes up with an hourly rate. And so as long as you charge all the hourly rates over time, you pay the salary and wages, you meet your budget in terms of overheads, you'll make X dollars margin. Okay, so that's the first thing. But a lot more goes into running an accounting firm than just the margin on the number of hours. We've got risk management, quality risk management. Our whole business is built around giving quality advice to people, giving quality advice to our clients. And so making sure we give the right advice in the right way to the right people at the right time is critical to our business. So we have to layer in a QRM process. This is reviewing the work. So someone does the work, somebody else reviews it, then it goes out the door. And again, that's a lot of common in quite a few professional services businesses. The formality, though, in chartered accounting firms, there's a lot more regulation around what we have to do and how we do that. Then we look at the balance sheet side of things. Okay, now again, we're a cash business. What I mean by a cash business is we send out invoices pretty regularly. The cash comes in pretty regularly. It doesn't take a lot of money to actually set an accounting firm up. As long as you've got a little bit of money in the bank, you need to be able to pay salary and wages for a period of time, and you need to be able to pay your overheads. Okay, we don't have to spend millions of dollars on capital items and you've got big trucks and buildings and spend millions of dollars on new pieces of software. Okay, we're not that sort of business. So we're capital light. So how much capital does it take to run an accounting firm? Well, again, I'll give you an example. This is kind of the average SME accounting firm in Australia. Your capital is typically needed around 3 months of P&L. So take a firm spending $100,000 per month on selling wages and overheads. Okay, they spend $1.2 million a year, which if you do the maths and work out the tree, revenues probably around 1.6 million. Okay, so that's 400,000 plus profit to the owner. But $100,000 a month, you need about working capital of about $300,000. And so why 3 months? Well, if you think about it, work can take 2 months, 6 weeks, 4 weeks to prepare from the time you start the work to the time you finish. Then you've got to send an invoice out, and then the client's got to pay the invoice. And so from that point, the time you start the work, and as you're spending that time doing the work, you're incurring costs, and it's going onto the WIP. I'll explain what WIP is in a minute. But you're incurring costs, you're spending salary and wages, you're paying your rent, you're paying your software costs, you're paying your insurance costs. All that cash goes out the door. Then you finish the work and deliver it, send the client the invoice when they're happy with it, and then they can take 14 days, 2 weeks, 3 weeks, 4 weeks to pay the invoice. And so from that time to that time is, 3 months is a good rule of thumb. So for a good small firm, by good I mean, a sole practitioner style firm with a few staff, having a few $100,000 in working capital is about where you need to be. If you're a sole practitioner, right, you can do a lot less than that. You could probably do with a few $1,000s. We can do it on a credit card, probably. If you're a big firm, multi-partner firm, maybe multi-office firm, you'll need several $1 million in working capital to keep the business running over time. So what is WIP? Work in progress. Right? This is the key to all accounting firms, indeed all professional services firms, whether you're a law firm, engineering firm, marketing, sales, any professional services firm has work in progress. Okay, that's the stuff that you started working on, but you haven't yet sent an invoice out for. So how does work in progress work? You take the number of hours you work on a job, multiply by your charge out rate, that becomes your work in progress. Balance sheet, simple. Then, when that work is finished, you invoice it. So it goes from being work in progress to being a trade receivable. And you can do some wonderful things with those numbers. You can work out the average time it takes you to start the work to finish the work. For example, take the average time to send the invoice out to receive the cash. That's called lockup. Days debtors and days WIP. You measure days debtors by simply taking sales, so debtors over sales, times 365, and days WIP is average WIP over sales times 365. And so for a firm like mine, for example, we run at about 50 days lockup. Really efficient firms can actually run a negative lockup. That means they bill before they actually do the work. A poorly run firm could be 3, 4, 5 months lockup, right? And lockup means how much time it takes you just from the time you start the work to the time the cash comes in the door. And you want to keep that as small as humanly possible. So in summary, an accounting firm is actually a really profitable, if well managed, firm to run. It has its moments. It's not without challenges. It's not without stress, as any business is, of course. Finding staff and quality staff is always an issue. Client management is always an issue. You've got lots of regulatory hurdles to get over and lots of professional development to keep up to date with. But it is a business that takes a very limited amount of capital to run. It has really good margins and a really good return on equity.